Thank you for joining us on what I hope is an exciting topic. I know that it is definitely one that we've been getting a lot of questions about: Trump accounts. I'm Joel Johnson, Director of Planning here with FourThought Private Wealth, and I'm joined today by Alex Herrington, our president and one of our senior planners here. How are you doing?
Doing great, Joel. How about yourself?
Doing good, thank you.
Good.
I've been getting questions about them. Have you?
I have a lot of friends and clients that have newborns and little ones. They've been asking about it, how it works, what they're supposed to do, and the whole process involved. So it's a good topic. Timely.
So let's kick it off with, this is apolitical in every sense of the word. We are not proponents. We are not opponents. They are called Trump accounts. That is the technical name of them. So anything politically charged in this conversation is completely unintentional. We are here just to give you good advice and talk through what these actually are so that you can implement it for you and your family. So let's kick it off. What are they? How does one open a Trump account? Who qualifies for it? And then we can dive into some more of the particulars.
Yeah, well, I'll kick it off and feel free to come over the top. But Trump accounts are newly established accounts for individuals, for children that were born between 2025 and 2028. So child has to be a U.S. citizen, has to have a social security number, and they're basically retirement accounts for infants. There's a special period if you were born between 2025 and 2028 that the government will actually seed that account with $1,000. So if you have a child that's born in 2029, the Trump accounts will still be there, but the seed money, that $1,000, at this point in time is going to cease. But ultimately, these are brand new accounts that they just released on the 4th of July.
Yep, absolutely. So they went into effect on the 4th of July. Very easy to find the application online. It's Form 4547. You fill it out. You have to be related to the child. Typically, it's the parent to open those up. And they just started sending out emails to actually get the accounts established with one of the brokers that they decided to go with. If I'm not mistaken, it's Robinhood or U.S. Bank. But you hit the nail on the head. The one that's getting the big headline right now is that $3,000. It's seeded by the U.S. government, but there are a couple of other folks that are able to contribute to the account. So walk us through that. Who's able to do it? What are the limits? And let's start with kind of individuals. What are those limits that we should be worried about?
Yeah, so on an annual basis, just like how we as adults have annual limits on IRA contributions, same for these Trump accounts. The annual limit is $5,000 per year. The $1,000 seed money by the U.S. government does not count towards that initial $5,000 if I'm correct, right?
You are correct. Yep.
So technically $6,000 for that, including that seed money, but every year thereafter, the limit is $5,000. Anyone can contribute to that account. It can be parents, friends, family members. There's even some employers that are committing dollars to the workplace plans. They'll contribute to Trump accounts for employees that have little ones that have Trump accounts established. So pretty much anyone can contribute to this account on the child's behalf.
Yeah, so here's the gotcha that you got to worry about. So the $1,000, you hit the nail on the head, doesn't count. You get it, that's great. It's $1,000 set aside. $5,000 limit, that's for everybody else, and that is a cumulative limit. So if the employer gives you $1,000, you can only do $4,000. If grandma and grandpa want to do $1,000, now you're down to $3,000. The other rule that you got to watch out for is you're only allowed to have one Trump account at a time. That way, the Fed or whoever's going to be watching over these things is able to track them easily so that you're not going above those limits. Because what they actually just came out with is rules that if you overfund a Trump account, like you would do with an IRA sometimes, with an IRA, it's fairly easy to reverse, right? It happens sometimes with us. Maybe you didn't meet the income limits, whatever it is. You basically just undo it. You pay a little bit of tax on any earnings, but it's fairly straightforward. With these, they made the penalty a little bit harsher. So what's going to happen is if you do have to reverse out, like let's say you did $6,000 on accident,
sure,
that additional $1,000 is actually going to be taxed as ordinary income back to you, the full $1,000. So it's just one of those nuances that come along with these accounts that you want to be careful of. So just key number one Trump account, $5,000 total for individuals per year up until the child turns 18. And make sure you talk to your employer if they're being overly generous in using these accounts, that you're not overcommitting or doing something without them knowing.
Good to know. You did mention there's a form that they have to fill out, but is there a way to do that digitally?
There is. Yep. So Form 4547. Some might pick up on why. But Form 4547, just find it online, a quick Google account of a Trump account application. It'll pop right up. It's the first thing on there. It's fully digital, basic information, like you mentioned earlier, name, social security number, that sort of thing.
Gotcha. So it establishes an account at U.S. Bank or Robinhood, which we can confirm.
Yep.
And then basically you can start contributing to that account, link your bank account to it and make contributions, share that same information with friends and family, and they can also make contributions to it as well.
Absolutely. Yep, exactly right. And then the final kind of contribution. So you've got the $1,000, you've got the employer, you've got the personal, and then the final type of contribution is non-charitable, or for charitable organizations to donate to. Now, these are really interesting, and you've heard some of the big headlines, like the Dell Foundation, I believe, made a pretty big commitment. Mm-hmm. They put really specific rules around that contribution that they are allowed to do. And what they're essentially saying is, yes, you can do this as a charitable organization. It's a great way to give back to your community, but that's actually what you have to target is the community. You're not able to give it to Alex and his kids. You're not able to give it to Joel and his kids. You have to target an area, define the demographic that qualifies for the contribution, and that's who gets that money. Complex. Don't know why they made it so complex, but they did. But that's another way that you might be able to get some money into these accounts. And so when you talked about the $1,000 contribution for children between 2025 and 2028, mm-hmm. there's an argument to be made. Maybe you open one just in case, and maybe you get a couple dollars in there from these charitable organizations, even if you don't get the $1,000.
Gotcha. Yeah, so it looks like these Trump accounts are run through BNY, the Bank of New York, Mellon, in partnership with Robinhood. So family opts into the account, gets created, and that's ultimately where it starts. Sounds like a Robinhood account.
There you go. Yeah.
So tell us a little bit about, like, what is the purpose of this account compared to, there's a variety of different accounts that you can establish for your kids, 529s for education, or custodial accounts. Like, walk us through why someone would establish this account versus others.
Yeah. So we talked about this earlier, and we've really been putting our heads together as planners at FourThought on how we think about these, because with everything new, you're going to hear the news, and everybody's going to potentially want to do this, and does it eventually, what it all comes back to is, does it fit our clients and their goals? And so the way we decided to kind of think about it is, much like we consider our lives in chunks, early career, mid-career, late career, if you're retired, early retirement, go, no-go, or go, slow-go, no-go years. Yeah. You can break it up however you want. We're starting to think about these accounts kind of in that same vein. So this is definitely, if you're interested in saving for a child or a grandchild's retirement, literally retirement, when they're 65, you put a couple of dollars in there, over 65 years, it'll compound pretty good. And that's actually a good point we haven't talked about. The investments inside of these accounts have to be an index fund at very low cost. So you don't get any say over the investment allocation. It's just going to be invested in the U.S. economy.
It's automatic?
Automatic.
Okay.
Automatic.
So there's no choices. It's
no choices.
Chosen for you.
Yep. Okay. So if you're a conservative investor, you're not going to like these. But over 65 years, which is the intended use of it, that's kind of what you're looking at. And then of course college. So talk about 529s and how those work and where that might fall into the timeline of a kid's life.
Yeah. So 529s are tax-advantaged accounts that are specifically earmarked for your child's education. And it doesn't have to be college. It could be private school, whether it's high school, middle school. It's basically an account that grows, and if that money is utilized for education, the growth or those distributions aren't taxed. So it's tax-free growth as long as it's used for qualified education expenses. So there's a huge tax benefit for saving for a child's education through these 529s. If the money is not used for 529s, then there are taxes and penalties assessed specifically to the growth of the portfolio. So 529s are very specific for education. Not that it could be used otherwise, but the tax benefits are there for education. Now that's different than these Trump accounts, right?
Exactly. And I think if we were to kind of prioritize, if you're saving for college education, 529.
Yeah.
If for some reason you're saving for a 1-year-old's retirement, Trump account. But you could. I said, they each kind of have their own uses there. And then, of course, you've got everything that is in education or retirement. And then you start talking about UGMA accounts and all of those sorts of things. So where would that fall in your tier if you were doing a plan for a client?
Yeah, it's going to ultimately come down to the client and what their priorities are. It depends on how much extra cash flow that they have to contribute to any of these goals for their children. The way that I look at it is if you want to intentionally save for your child's retirement at a very early age, a Trump account makes a lot of sense. If you want to save specifically for education, 529s. If you want your child at 18 to have their own accounts, their own money, you can contribute to UTMA or UGMA accounts. They're irrevocable gifts into a child's account. And when they're 18, it's legally theirs. Really no major tax benefits. You can talk about the kiddie tax here in a little bit on these custodial accounts. But those are typically, I recommend those to clients that say, hey, I want my child to have money for a new car when they go off to college, or I want them to have some money for a new house, or just for spending money. A custodial account is an irrevocable gift, basically an investment account that becomes your child's legal account at 18 that they can use for pretty much anything that they want. So it's typically not one or the other. Sometimes it is, if it depends on the cash flow needs that a client, or the cash flow that is available for that client to invest additional dollars. Sometimes it's a combination of one or two, or potentially all three of them. But these Trump accounts are very much geared towards saving for their retirement. Mm-hmm. There's some caveats on what they can use those Trump accounts for at age 18, first-time home purchase, adoption expenses if they're older. What else is there for these Trump accounts, those exceptions?
Yeah, once they turn 18, it's basically just like any other IRA.
Okay.
So I mean, whatever IRA rules you're familiar with plops right onto the Trump accounts, which is actually sort of good news because that means it's a little bit more familiar once you get to that stage for clients. You can do things like Roth conversions, and there's some more advanced techniques and things that we can do for families in that situation. So once they actually turn 18, things actually get a little bit more simple because then you don't have all the contribution rules. You don't have to worry about the investments anymore. You can do basically whatever you want with it at that point. Now, much like the UGMA or the UTMA accounts, it does become your child's money at that point. Same taxes and penalties that an early distribution from an IRA would carry with it, so hopefully that's something of a deterrent. Other times, you gave me a couple $1,000s while I was in college. Who knows, right? So it's definitely one of the considerations. But when you're talking about legacy planning, which is all of our focus here at FourThought, this is definitely another tool in the tool belt that you can use.
Yeah, I mean, it's, previously to contribute to a child's retirement, they had to have some sort of earned income. And what 2-year-old has earned income? Legally, probably none.
Coppertone baby.
Yeah. Gerber baby that has
there you go.
Photo shoots. This is actually a way that you can contribute to your child's retirement. Before, they had to have some sort of earned income, whether it was working for mom and dad or their own endeavors at an early age. But this is a way to put more money into an account for your child's retirement. As Joel mentioned, they're IRA accounts, right? So they're called Trump accounts, but it's basically an IRA with Trump in quotations mark over the title. So it acts just like an IRA account would, and again, it becomes theirs at age 18. So just a great way to save additional money for your child if you want to save for retirement for them.
Yep. So summing it all up here for our clients or whoever's watching this at home. If you've got a child born between 25 and 28, you get the $1,000. Zero reason you shouldn't take that. Go ahead, fill out the application, get the account open, take the $3,000. Easy peasy. Beyond that, for most families, I think there are better options. This does come with a lot of trickiness to it, a lot of complications. Again, if your goal is that retirement, that's great. Typically, it's not, though, for most of the families we work with, so it's just something to be aware of out there, but probably not going to be overly used. But then, again, you get to the other side of that and you start talking about legacy planning, and then it kind of comes back into play as another way of getting tax-deferred growth to future generations. So I don't think it's as easy as us being able to sit here and just say everybody should be getting these. I wish it was that easy sometimes, but then we wouldn't have a job. So
Comes down to priorities, and that's what financial planner does is they sit down with you and your family and figure out if you have extra dollars to allocate towards a specific goal. We can sit down and help you figure out what account makes the most sense. Everyone's different. So welcome that conversation.
Absolutely. And if you would like to have that conversation, happy to talk to you. Reach out to us or any of the planners here at FourThought. We're happy to discuss Trump accounts or any other ways of saving for your child's future. So thank you for joining us.